let's do this. Let's talk about what's going on. Um, Needless to say, there have been, a series of events that have occurred over the course of the past 2 months that have created some, let's say, feelings of uncertainty in terms of both markets, in terms of the economic picture of the United States, in terms of our personal financial pictures. There are a lot of questions out there. And before I get into anything, I think it's important to just note it's normal to have questions. It's normal to have questions, especially when we are probably witnessing a fairly significant paradigm shift in the trajectory of how things are going to be handled. And that's not because of a certain election. And I think that that's one of maybe the pieces of conversation that's missing. Um, we are reaching a point, both politically, economically, broadly speaking, culturally, I suppose, where control of information is disintegrating. I personally view that as a very good thing. But for most people, it's incredibly disarming, or rather, not disarming. It's incredibly disconcerting. It's incredibly uncomfortable because it's shaking up what we have come to know as a status quo. And the reason I bring that to mind is a lot of what is going on that is creating such angst and anxiety. And this is not only something that I've observed anecdotally in having conversations with people of all walks of life. One of the great challenges that is being faced by, and this matters because this is, it's faced by markets, right? Markets are a collaboration of people and ideas that are coming together to identify the appropriate pricing and the the future potential of various investments, of the economic landscape as we look forward. Right, there's a lot of, it's all human at the end of the day. It's just a massive amalgamation of human ideas. That's what a market is. But transparency, often we're basically seeing a tremendous amount of new transparency, and that can be shaky. That can be difficult. And that's because once upon a time, and this has gone on for ages since humans have joined together in communities. There have been controllers of information, and we still certainly have certain informations that are not, let's say, displayed publicly. But since the advent of both internet and mobile devices and social medias and you name it, we have more transparency than ever before. And I think that that is now amplified by an administration whose, at least so far, sole objective is to bring transparency to something that has been a very controlled narrative for most people. And because of that, now all of a sudden it's like, I've used the analogy, heck, I did this back when Trump's first term, why, trying to come up with an understanding of why so many people so viscerally hated the guy. And it was every politician across the board has skeletons in their closet. But most politicians have a solid oak door with five deadbolts on it. Trump came in and it was almost like he had like a screen door on his closet. Like everybody was looking into it. Everybody was seeing how many skeletons he had in his closet, how many bad decisions he's made or whatever, because he's had this public profile. And there were plenty of people trying to dig up dirt because they didn't like him for, again, whatever reason. It doesn't really matter. But there was transparency then, and it caused a little bit of a kind of a discomfort. Oh, and that's why a lot of the character assassination and that kind of thing. And it's like, look, all these people have nasty, dirty secrets. Some of them are just, I guess, much better at keeping them a secret. But that creates uncertainty, and now we're getting it economically. Right now, we're getting these shakeups in government departments and spending, and really you're having to face something that we all kind of had this like kind of sneaking suspicion. Boy, I pay a lot in taxes every year. And where's all that money going? Because I don't see it. I don't see the benefits around me. Or, those that are a bit more, let's say, accounting minded actually break down the numbers and they go, something's just not adding up. It doesn't make sense. And now all of a sudden we're kind of forced to face something that we would kind of rather just, I know it's there, but I'm just going to pretend it doesn't exist. So that's creating a tremendous amount of uncertainty. Even though there's more transparency, it creates a feeling of unease because it forces our human minds to try to analyze more variables. And when more variables have to be considered, not to say we freeze up, but we're not really good at it. There's a lot of behavioral science that has gone into this, and there's great research where it's like I'm forgetting the name of the principle because of the individual that kind of put his finger on this, but it was basically the problem with humans and how we don't deal well with really large quantities of things. So if you say, hey, there's $1 trillion in debt being added, every month or every year, or whatever the circumstance, you say $1 trillion, okay, I don't know, $1 trillion, and then all of a sudden, when you back it into, how many, let's say, you put it, you frame it into the context of something that's actually understandable, it radically changes the way that you kind of look at things. And that's, I've seen people say, like, if you took a made one day, $1 million, $1 trillion is however many years, and I don't actually know the figures, but the idea there is all of a sudden when you put it into a context that's actually digestible, it radically changes the scope of things. um, Big numbers mess with us, like a billion here, a billion there. You don't even realize that a billion is 100 millions. That's like a really hard idea. Be like, I don't have just 1 million, I've got like 100 of them. Okay. So then you take that idea and you build upon it. And now it's okay. So we've got all these big numbers, and then we've got a bunch of different sets of big numbers. So again, average individuals are just like getting just washed with all this information. We don't really know what to do with it. Is it good? Is it bad? They can't distill it down. And then even the experts, for whatever that word is worth anymore, they're more often than not picking the data because there's so much of it that they want to push whatever their agenda or whatever their story that they're trying to tell, and they're leaving out the other data in a lot of ways. So then you kind of either find yourself back in the echo chamber, or you find yourself going, I don't even know what to believe. So it causes this just, yeah, we all get that feeling. It's like, I just want to go sit in the corner and just kind of ignore it all. And in a lot of ways, we think that there's these brilliant, let's say, institutional money managers and hedge fund managers and all these investors that are just such great investors. Yes, they are, but they're still human at the end of the day too. And they're still subject to these same problems. They tend to be pretty good at quickly figuring out a methodology to apply to then make good decisions on. And not to say that I'm one of those brilliant minds, but that's exactly why I use a methodology to navigate markets, because I look, I'm just a human too. It comes in, it's like, I I'm not sure what to make of all of this when it hits you. And then to go a step further, I'm one of those who I kind of take pride in being overly critical, I would say, of all the information and not falling prey to the narrative based storytelling approach of data dissemination, where I kind of fall into believing something that's just got a good story, but it's not actually true. And on the other side of that spectrum is the media, right? If you call it legacy media or whatever it might be, like their whole plan is to make sure they disseminate all this information in a way that it's catchy little tidbits. Because at the end of the day, the biggest problem we have, if we have a problem, when I don't know that we do, again, I'm going to be overly critical of both sides, but the biggest problem we have is, in an attempt to deal with the problem of transparency, or at least a tremendous amount of information hitting us all the time and new information coming in all the time, we've really narrowed our scope on a lot of things. So this is pervasive across life, but I'm going to use kind of as a proxy example. I'm going to use corporate leadership. Businesses, companies, especially large ones, have become so acutely focused on their quarterly earnings that the creative decision making is effectively toast, right? That's something that, you know, it's very rare that you're seeing corporate leadership that's willing to take risks, that is willing to make, let's say, create, and I say creative decisions, meaning out of the realm of the bowling alley bumper lanes. Um, and they're measuring their success in incredibly short increments of time, which I get it, right? If you're going to go to business school, virtually every MBA program out there is going to teach you the number one goal of a corporate leader in a publicly traded company, especially CEO, whatever it might be, is to optimize, maximize shareholder value. Okay. But that gets then redefined or spun or twisted a little bit into measurable shareholder value on a quarterly basis. Right. So is that really shareholder value? It's hard to say. I mean, sure. But that's why we get this kind of routine every, 4 times every year. We go through earnings season and we get these kind of wacky blips in the market left and right. Okay. But we want to do these very measurable things, not immeasurable or intangible things. We don't want to make intangible decisions because you can't justify that to shareholders. And we also want to make these decisions that are very short sighted because most shareholders don't have the stomach to weather the necessary storms for creative, let's say, advancement. And you can use a variety of companies going back. The ones that were real trailblazers in their various industries were the ones that made incredibly difficult creative decisions and weathered the storm, right? Like in most recent history, Jeff Bezos comes to mind for a lot of investors who have followed market history, because this guy was this kind of like geeky Wall Street, hedge fund manager kind of character who decided to go sell books on this internet thing. And everybody kind of was like, what on earth? And needless to say, behind the scenes, he was doing a lot more than selling books on the internet, right? His web services, eventually Amazon becoming what Amazon did, and then creating the marketplace where it's like, I'm just a facilitator of transactions. And now it's logistics and shipping. There's so many parts to the puzzle, but shareholders were not happy with the guy for quite a period of time. Um, but again, that's a long term strategy. Most companies aren't doing that. And most investors aren't doing that either. And this is where it gets to the kind of the crux of what we're looking at. And then I'm going to actually get into what's going on in the market today. But I think that this is the important setup, is we need to reframe as we look at life as decision makers for our own plans long term, right? If I were to tell you, hey, where were you 25 years ago? It's really hard to sit there and go, where was I in year 2000? That was the height of the tech bubble. That was the height of the internet tech bubble. Go buy a bunch of companies that have never done anything. There's a famous pet food company that I won't call out by name. They've had their fair time in the public zeitgeist. But these are companies that had absolutely nothing. They didn't hardly even exist except for on paper. They had no business plan or nothing. But hey, they were on the internet, so let's go ahead and just throw money at them. And then of course you had this just colossal crash, specifically in that space. But that wasn't the end of the internet, right? There wonderful things happened since then, and terrible things, but a lot of wonderful things. I would say the wonderful outnumbers the terrible. Um, but again, like, to think 25 years, I mean, not to say that's not a long time, it's a long time, but it's also not a long time. If you're, let's say, 50, that's 75. If you're worried about Social Security at age 50, okay, like 75 is, let's just say for the sake of an argument, very well could be the age where you begin drawing Social Security because of Probably won't reach, down the ladder that much, but they'll probably end up pushing the age out to some degree. Um, 25 years isn't as much as we think it is if we're long term oriented, but we don't tend to be. So again, we look at market events, we look at 3% or 5% or 10% drawdown in the market or whatever it might be. And it's, because we've been focused, we've been funneled into this belief of looking at everything very short term and looking for immediate results. That's been doubly amplified by the fact that the past 2 years have had artificially high market performance. Frankly, the past 5 years, if we look at what happened in 2020, the artificial run up of the market, which was basically just money injection, money creation, money injection, inflationary policy, terrible decision making politically, and then trying to backstop the terrible decision making with an artificially induced stimulus that then we're suffering the consequences of as average, let's say average everyday Americans. Meanwhile, anybody who had significant portion of their wealth in in assets that can basically weather or benefit from inflation, which is invested assets by and large. Okay. You know, there was a huge shift in wealth transferring from the really the bottom 90% to the top 10%. But it's even more exaggerated when you look at the bottom 50% because they generally, as Americans, are not folks that have a tremendous amount of assets and investments. So they're not participating in the investment run up, but they are participating in the inflationary pressures of everyday grocery shopping and whatever else it might be. And all of that is a byproduct of money printing. Inflation is a monetary phenomena. And that's also going to play in when we talk about the big news right now. Okay, so bear with me for just a second. But I bring all of this to mind because we've become very short term focused. We don't want to look at things as investments. We want to look at them as speculative uh, gambles. And that is detrimental. It is reinforced and encouraged societally. We see it in CEOs making decisions, we see it in a lot of politicians' decisions. What we're seeing right now, coming down from the federal level and through various states, arguably is longer term in nature. But that also means if it's ever going to work, if there's a long shot hope of it working, it has to be given time to work. And chances are it won't be given time. So that creates the argument of is this actually imprudent? Maybe, maybe not. And I say that because is it better then? Is it more responsible, or is it more prudent to continue the horrific trajectory that we were on in terms of spending money that we don't have, placing an undue burden on our next generation and their next generation and their progeny. Um, it was kind of like a damned if you do, damned if you don't. Forgive the language, and that's kind of what we were dealing with. So all of these shakeups, and I'm gonna kind of break down what's maybe really going on, if you will. But all of these shakeups may be longer term in nature. If that's the case, if that proves to be true, and if we can actually stick to it, I would say that's one of the most optimistic things we could have happen because that may be the thing that shifts public opinion or, again, kind of culturally accepted norms to looking longer term again. In a lot of ways, I'm kind of looking at this sort of maybe through the lens of like the Strauss Howe fourth turning generational cycles. I'm a big cycle believer. You all know that. But we might be seeing sort of a rebuilding or rather a destruction and rebuilding phase playing out. The question is whether the right decisions are going to be made. And that is one that has yet to be seen. All right. So, with that, let me stop here. Now I'm going to get into what's actually going on right now. And then after that, I'm going to break through a couple of charts that I think are worth uh, kind of reflecting on. Because at the end of the day, a chart is nothing more than visually representing information. I know that sounds like a really, really weird way to talk about. Well, no, a stock chart shows the price. Yet, what the stock chart shows is it shows what buyers and sellers believe the price should be. because the only way it gets to a higher price is if somebody's willing to buy it up there and somebody else thinks that's a good price to sell it at. If I own a stock and I say, you know what, I think that this thing is worth more. It's trading at $100 and I think it's worth $150. I'm not selling it at $125. But there might be plenty of people who say, I also think it's worth $150. So I would like to buy it at $125. The only way they can do that is if somebody else says, I don't think this thing's worth $125. So they go to sell it. Okay. So what we see when we visually represent markets in charts, and it can be the same for economic data, it can be this, it's creating a picture to digest information. That's the moral of this whole story I'm telling you is a lot of this is how can we consolidate information to create something that we as human beings who love our stories, that's what our brains are built for, is stories. That's what it's one of the great features of humans. But my story right now is we have a tremendous amount of transparency and new information we're being flooded with. We are trying to figure out how to digest it. Okay. So one way we can start is let's look at charts. Okay. So the big story, of course, tariffs. Right. That's the headline runner. That's the thing that's going on. Behind the scenes, though, there's a couple of other things that I think we would be prudent to kind of bring into conversation, and that is 2 days ago. So today is Wednesday, March 5th. 2 days ago, on the third, the Atlanta Fed, so the Federal Reserve of Atlanta, they they're tasked, one of their kind of features as their bank, each of the Federal Reserve banks has kind of their own, let's say, mission. The St. Louis Fed is the big data aggregator. They produce and publish tons of data. The Atlanta Fed, they tend to focus a lot of their attention on GDP forecasting. So they have what they call GDP Now. I'll put up a quick clip of their released report on Monday, which, as you can see here, um, not pretty. They're revising down first quarter estimates to a negative 2.5, maybe negative 3% decline in GDP. So that, and it, all of this being said, is this is not like the market was at all time highs 3 days ago, right? Markets, let's call it the S&P 500 down, whatever you want to kind of pick. We were trading at all time highs way more than 3 days ago. It was S&P was I think 14 days ago. Okay, so we had already begun some selling, but we get this GDP Now figure the day before Trump's imposition of these tariffs that the can had already been kicked down the road a little bit back in January. But we get the GDP Now revision figures. Now this is the third, I think, time that they've revised these for quarter one. That's normal. Okay. But each revision is going down. That's not normal, at least in recent times. Now, one of the ways you interpret this is you say, well, they cut all these federal workers, okay, even though they're still getting paid. So you got to be really careful with that. The whole premise behind these kind of hacksaw cutting of departments that had, I'm gonna layer in a little bit of commentary here because I think it's necessary. And a lot of people don't want to accept this as truth. Our government has grown so exponentially and so large that its weight is not going to be able to be bare by the economy much longer if it were on its trajectory. Almost all of the job creation over the course of the past 3 years has been net government jobs. It's not to say the private sector hasn't hired people, but these strong jobs reports that you kept getting were not strong jobs reports because of mom and pop shops around the country hiring new people. It was all government workers. And that's not good because the government does not create value for an economy. People like to argue this point a lot. It is not a point worth arguing. The federal government cannot take in raw materials, apply craft skill, resource time, and then bring to market a final product that is of greater value to the marketplace. Okay. It cannot do that. The government is simply a vehicle for transferring value from one to another. Again, it's a bit of a hot take for some people. Some, "Oh, no, that's not how that's not true. That's I it actually is true, and it's measured and it's very clear, because at the end of the day, the way that the government makes money is not to sell a product. Okay? And that's where it it's kind of a proof positive, is they cannot create revenue, in other words, trade a marketplace for their product. The only way their money comes in is they take it from corporations, which are technically not people, they're entities. So they treat them a little bit differently. And then people, right? Hardworking Americans. And then of course, the joke is, okay, so my company gets taxed because I made something valuable for them to sell, or good or service. And then I get taxed when they pay me. And then when I go and spend my money, I get taxed again. And then when I buy something like a house, I then pay tax on that land forever. And then when I die, I get taxed again, right? That's the old joke. It's also a true joke. But that's the point, is that that's how revenues are created. There's no other way that the government creates revenue. So it's just taking value from one to reassign to another. When that's the only place creating jobs, that's not strong for the economy at all. It also has led to the extreme overregulation, because a lot of these departments are self justifying. They need to have a purpose. Otherwise, why are they there? So oh, we need to regulate this. We need to regulate that. We need to control this. We need to control that. And it leads to an extreme amount of overregulation, which we've witnessed. And that can also be evidenced by looking at large cap companies' success with their regulatory capture versus small companies and mid sized companies that simply cannot break out because the regulatory hurdles and burdens are too high. So we get this massive concentration effect. I'll talk about that when I look at the charts in just a minute, because we have a three-part concentration that's not being talked a lot about. I'll mention it in a minute. But let's go back to the GDP figures, because these GDP revisions down, one of the arguments is it's revised down because of all these baddies, these bad guys in DC that are going in and just chopping jobs left and right. And all that income, right? They get paid a salary, is not going to be spent into the economy. That's actually not what caused the GDP revisions. The GDP revisions were actually due primarily because there was a significant amount of import of raw materials, of industrial materials in the first quarter. Why? This is going to relate to point number two, which is tariffs. A lot of companies, knowing in this, again, transparency, right? I'll give them credit. At least he platformed and he ran on this premise, and this is Trump I'm referring to, that it's not like it was a big secret that Elon Musk was going to be tasked with this Doge concept. But then once it happens, it's like everybody's waving their hands in the air, like, how could he do this? It's like, well, he kind of ran, like he was pretty clear up front about it. And that's not me trying to be politically like a political pundit. That's just like, again, the transparency was there. I'll give him credit for that. Okay. But one of the other things was, I want to get rid of our tax code and I want to just use tariffs. And then once it happens, it's like, like what a tariff. Look, he's been telling you he's going to do it. Like, why are you so mad when he actually fulfills a campaign promise? I guess it's because we're so used to politicians not fulfilling campaign promises. But let's dive in a little further, because we need to be critical of this. This isn't all good at all. But the idea behind the GDP figure, just to put a lid on that, is the GDP figure revision down was because of this massive import of these, industrial materials, raw materials, and that's basically countries saying, "Hey, ooh, crud, we're going to be getting these tariffs put into place." Metals, right? Aluminum and copper, and which copper's having one heck of a day today. Um, for a separate note, but aluminum and copper and whatever else it might be. We're supposedly going to be getting these semiconductor plants built here. We've got big manufacturing industry commitments. We'll see if they actually come to fruition. Not yet to be seen. But all these companies were basically saying, "All right, front load. Let's lock in at least a few months worth of materials, Because if we get these tariffs, we don't think they'll stick or whatever their opinion might be, but they're probably going to go into place. So like, let's go ahead and let's load up. All right. So what that did was it crushes the GDP estimates. Now, does that mean that there also aren't other factors? No, there absolutely are. Right. Jobs numbers are not going to be pretty. Right. We know that because they're cutting a lot of jobs right now. So the important thing is let's focus on like what was the big differentiator, and it was the industrial materials imported. All right. So Monday's news, not to say it wasn't an important news item, GDP now figure, it's an unofficial estimate. It is an estimate. Quarter one still has another month to go. Okay. But let's just kind of set that aside and say, nah, maybe we're going to let that not be a huge decision maker. All right. Let's step into tariffs now. All right. So tariffs, yes, Trump put his tariffs into place. Now, even since then, um, just to reiterate or to refresh anyone who's not familiar, um, tariffs on both imports from Canada and Mexico, and then an additional set of tariffs placed on China. Now, the reason that this is significant is these were basically imposed already, but because of conversations with leaders, decisions were made. Let's kick the can down the road until March 4th. No resolution was agreed upon with parties. I would say that that's probably more intentional than not. And it's not to say they couldn't come to resolution or agreement, but it's way easier if it's let's not make any concessions. If I'm Canada, if I'm Mexico, and then let's wait because everybody's going to paint Trump as the bad guy when he puts the tariffs into place and whatever it might be. On the flip side of that argument, right? You have Trump and his administration and his cabinet putting these tariffs into place. And their whole thing is we have to do it soon because when things go wrong, which they inevitably will, we can blame it on Biden. I know that sounds crazy, but that's why the first 100 days of any presidency is so important. Yes, there's campaign cycles that are going to kick up for midterm elections, and there's, you know, you got to strike while the iron's hot. There's all these other rationales. But ultimately, one of the main reasons why the first 100 days are so important is you come in, you do something radical, and if it doesn't work out, you just go, it was that guy's fault. He's whatever they did made it so that our great idea doesn't work. Okay, we can see through that. Okay. But that's the kind of the ping pong battle. So as these tariffs go into place, an important note to remember is in a combination. It was between 2018 and 2020. The North American Free Trade Agreement was disbanded. It was done away with. Most Americans don't even. They're like NAFTA's gone. What? It was replaced. It was replaced with a new agreement, and effectively, what it said for Mexico and Canada is that any bilateral trade was free trade. Okay. No tariffs. Okay. There were a handful, and they usually represented something like under 3% of the total trade between the two nations, of items that did not qualify for the bilateral trade agreement. And in the case of Mexico, those items, Mexico actually has a 7% tariff on American imports of that very small but still significant list of goods. Um, that America, was exporting. Now, in the case of Canada, the rate, the tariff rate, not as high as Mexico, but it was still higher than America's 4 point something. So, it, while yeah, bilateral trade is effectively, let's call it tariff free. The areas that weren't, which again, very very small percent, were not balanced in terms of America being, fair, right? We were getting the short end of the stick. Where things get even more interesting, though, is there were some additional tariffs, especially with Canada, that were imposed on U.S. Energy and agriculture, if I'm not mistaken, which were significantly higher. And there's even some that are like up to, I think, like right now, even some very small again percentage, but like up to 300%. Um, Plus, there's also regulations on American banking in Canada and a couple of other kind of, let's call it, protective tariff adjacent policies. So like we aren't getting a fair shake here. Um, that's the problem when we talk about tariffs is they're used as like this big bad thing for America. And how dare they impose tariffs? And I'm not a fan of tariffs, right? Tariffs are a tax. That's all they are. I am not a fan of tax. All right. So let's make that clear. But they're also spun into something that they may not necessarily be. And I think a great way to sort of highlight that point, if I were to ask you what percentage of our GDP is represented by imports, most people start with a guess, anytime I ask, they usually think it's north of 50%. And that's simply because, like, from an anecdotal point of view, we think about all the stuff we buy from China on Amazon, or whatever it might be. But the reality is that as a percentage, again, a percentage of our GDP, the imports represent somewhere between 13 to 15%. So it's not like we have this massive amount of imports net. It doesn't mean that we don't import a lot of stuff. It's still a ton of stuff. But anytime we start talking about tariffs, it's like, what are we really imposing here? Now, I'm going to step away from just the raw conversation around tariffs, and I want to completely dismantle a fear mongering tactic that's used by anybody right now who wants to talk about tariffs. It's that tariffs are inflationary. Okay, now in the past, I have said that tariffs are inflationary to the consumer. And I think we have an important distinction to make here because tariffs, in and of themselves, are not inflationary. Tariffs are inflationary from consumer pricing because they cause prices of some goods to go up, but they are not economically inflationary, meaning they don't create what would be measurable inflation. They create an inflation in the cost of your goods that you may or may not buy, or your energy, or your agriculture, or your right. Because more often than not, on the end of the producers, they're going to pass the cost on to the end consumer. Okay. But inflation, as I think I mentioned before, is a monetary phenomenon. The only way you get inflation, despite politicians that will tell you differently, despite some economists who, for whatever reason, people still listen to, will tell you otherwise. But inflation only happens when there is more money chasing the same amount or less goods and services. Okay. You have to have the more money component. Inflation doesn't occur in nature, inflation is a man made creation. So, one of the big things going on right now, and this is going to play in because I'm going to show you a chart in a minute about the dollar. But if you took the time to take a look at the newsletter that I sent out at the start of the year, there's a currency war going on that most people are completely oblivious to. It's not being discussed. We get lots of news stories about Bitcoin. We get lots of news stories about the dollar. We get lots of news stories about tariffs and trade wars right now. Um, but what we don't really get a cohesive conversation around is the idea that we're witnessing globally a very distinct war playing out around how global commerce will be conducted going forward. The standard, if you will, the kind of modus operandi that we have been operating on is that the dollar denominates virtually all international and global trade. Now, that matters because A, what is classically referred to as dollar hegemony is one of the great weapons that a U.S. uses to solidify its position as a global leader, both economically, militarily, and culturally, frankly. Because at the end of the day, for other countries to trade, more often than not, they need to play nice with America. This was put on full. This was put on display in 2021, 2022, at the onset of the Russia Ukraine fiasco, its current iteration playing out, because America, for the first time ever, and I've talked about this in previous videos, weaponized the dollar against another nation in a way that was really unheard of. And that was literally the seizure of assets of citizens of other countries. And granted, yes, many of them were oligarchs. So can you call them a citizen? Kind of, sort of, not really. Not to say these are good guys or bad guys, but the idea that America all of a sudden said, we're going to use the dollar against another country to achieve some type of either political, geopolitical, whatever means we're trying to achieve. The fact is that was a precedent set. All right. That precedent was something that had been toyed with quite a bit. I mean, Iran and sanctions and this is not like new to anybody who's ever paid attention to geopolitical global affairs, even in the slightest bit. There's always some kind of sanction, this or right now the hot button item is Chevron in Venezuela. Yeah, Trump has basically put the kibosh on doing any kind of business. Chevron, basically their oil leases in Venezuela cut off. We're not doing that anymore. um Good, bad, or indifferent, the point is that's economic sanctions. Weaponizing the dollar is a very different game. And because of that, we ended up getting China and Brazil and other nations that decided, wait a minute, what if we start transacting not in the dollar? What if we start denominating our trade in something else? And China's been a big player in this, trying to basically get their currency, their renminbi, to act as a surrogate for the dollar in international trade, especially with their trading partners. Now, I don't want to go all the way down that road because I think that's this time can be better spent staying really kind of narrowly focused on what we're seeing domestically. But the point is that that's one iteration of the currency war. Take it a step further, and you look at things like cryptocurrency, which are hot button items right now, right? We've got this sovereign wealth fund, which is a concept Americans are not terribly familiar with. Um, if you pay attention to other nations, Norway is a standout. Their sovereign wealth fund is effectively one of the largest in the world. Saudi Arabia is pretty close up there too. But you know it's something Americans don't really understand. And the idea is that a nation, a federal government, actually has, let's call it, a portfolio. That's kind of what it is, where they actually own investment assets that have a productive nature to them. So the U.S. government, it's not like the U.S. government has like their trading portfolio, right? Um, that hasn't existed. Now we have a sovereign wealth fund, and in effect, uh, the nation's wealth is to then be invested. Now, where does the nation get its wealth? That is yet to be determined in a lot of ways. But one of the big pieces of this is they're going to have a cryptocurrency reserve in the sovereign wealth fund. So all of a sudden, there's all this renewed talk. Well, what's the point of having decentralized finance, which is what cryptocurrency is supposed to achieve, specifically Bitcoin, to be very clear, not Ethereum, not XRP, not any of these other, I'm blanking on the names, some of the others that have been talked about being put in there. But Bitcoin is without saying something that is actually false but sounding true, I want to be really careful. I don't want to call Bitcoin digital gold. I hate that. It's not digital gold for a slew of reasons, but it has a ton of the same properties as gold. And that's bringing our third player into this mix, right? So, currency war is literal currencies, Bitcoin, cryptocurrency, and then gold, specifically gold and silver, but or rather, gold and silver, but specifically gold, because gold is doing something very different right now. That's not mm, in, again, kind of the public zeitgeist, and it may have a lot to do with what we're seeing. We have yet to find out. But with the whole currency war thing happening, the whole premise of tariffs, and there's a reason I bring all this up, is the war is like trying to decide, okay, how is the world going to conduct business going forward? What's going to rise out of this war as the dominant leading conduit for international trade. Maybe nothing will, right? Maybe we actually take steps back where trade is conducted in a way that there isn't a denominating currency to value international goods. It's not likely, but it could always happen if there's no agreements and everybody kind of goes rogue and does their own thing. Mm, again, probably not likely. But we bring the tariffs into the conversation. And one of the interesting things that happens with a tariff, believe it or not, devalues the dollar. And a lot of what Trump is doing are devaluing the dollar. I'll show a chart in a second. But before I do, to keep things narrowly focused on this conversation, why that matters is Trump is talking that he wants the dollar stronger, right? This is like commonly used playbook. You tell them you're doing one thing, and in reality, your end goal, right? The Machiavellian side of things, the ends justify the means. The end goal is something very different. When it comes down to, the dollar and US debt and you know, kind of the secret, if you can devalue the dollar significantly while still keeping stability in an economy, your debts shrink. When you look at the dollar, right, you devalue the dollar, right? You make it worth less. And all those debts that are out there, right, become cheaper per se. And then they actually do. But you're not actually putting the onus on, let's say, the private sector by way of inflation, because inflation devalues the dollar equally, right? But devaluing the dollar through other means like tariffs, which again, they create inflation from the spending side, but they don't create economically measurable inflation because you didn't create new monies. And I know this, it's a frustratingly complicated concept to sort of wrap your head around. And as I'm trying to explain it, I realize, you know what, maybe I don't even understand it as well as I think I do, because you're supposed to be able to explain something to a kindergarten if you actually understand it. um, I mean, truth be told, like it is it's a very difficult conversation to have because it's so much easier to say tariffs create inflation. That's how it goes. But they don't. They actually don't. No new money is created. So the fact that the Trump administration is not printing new money, but is instead clandestinely trying to devalue the dollar while saying their goal is to bring the dollar's value up. The reason that, or why they say they're bringing the dollar's value up, is they're basically making our economy stronger, which a stronger economy would mean that our dollar is worth more, because people would want to buy our dollar, park money in our dollar, right? Buy US debt because it's worth more globally. And if we're manufacturing all these things and if our economy is so robust and da 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 da, right, our dollar's stronger. Meanwhile, though, they're implementing policies that would actually weaken the dollar. Okay. So it's not 4D chess by any stretch of the imagination, but it is most certainly chess, right? It's not checkers. So is it going to work? Well, one of the key cotter pins, linchpins in this whole thing is what's going on with the dollar. And that's what makes gold so interesting right now. Most people don't have a clue, but for the past several weeks, we have had a massive amount of net imports of gold bullion to the United States. Some have said, oh, that's because the tariffs were coming in and cost to vault and transport gold is going to be more expensive. And if you wanted to repatriate foreign held or foreign vaulted gold, it's going to be more expensive because of tariffs and trade wars. And it may be that the other country tries to punish America by putting tariffs on transportation or moving gold around on contract deliveries or whatever it is. It's probably something more along the lines of monetizing our dollar with gold. And there's a lot of early evidence that's suggesting that that may be what is going on, is that dollars or rather, gold is being pulled back into the United States, not to necessarily restock Fort Knox because it's empty, but instead to have domestically held gold bullion that can then be readily held as maybe a back for the dollar. Will we go back to the gold standard full stop? No, it's not going to happen. I can always be wrong, but it doesn't look likely. Could there be some way that gold is reintroduced to the conversation around the dollar to lock it in from being printed to buy all kinds of nonsense garbage that the government's been spending and wasting dollars on? It very well could happen. And if that is the case, that is one of the most optimistic things happening that no one is thinking about right now. And if that is the case, and it will justify all of these tariffs, because what it's doing is it's a watch over here while I do this over here. Now, if I'm wrong about the gold thing, very well could be, right? That's just early evidence, but that's what it's currently suggesting. Let's push that aside. Let's assume, Casey, you're totally wrong. Okay, fine. Go back to tariff conversation. If we assume that the gold conversation is wrong and the currency war is actually going to be won by the US dollar because the US dollar is now going to be predicated on a finite resource that actually has intrinsic value and is immutable and historically has drawn humans to it since the dawn of time, and everything else that the crazy gold bugs out there, which they're, some of them have good points, some of them are just lunatics, but the fact of the matter is gold is so unique. Most people have no idea how unique gold is, how wildly cool it is. But go do your own research. It's fun. Assume that's all wrong. Go back to tariffs. We are now at the point of the carrot and stick part of the conversation. We saw the stick side of the conversation when Trump rolled out the tariffs the first time. He went into Mexico and Canada, he whacked them with a stick, and he said, tariffs. And they said, whoa, 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 let's have a conversation. Let's push these off for a little while. Let's talk. Okay. They didn't talk. March 4th, yesterday happens. Tariffs. They're in place. Now they get to go, wah, wah, wah. Tariffs, how you're bad, you're bad. We're going to retaliate. You're bad. We're going to retaliate. Again, this is assessment number 2 of tariffs. This is where the Trump administration now all of a sudden says, now we have a carrot. Now we have something that we can take away if you're willing to play ball. So instead of hitting you with them now, we told you they were coming. You didn't negotiate, whatever it is, right? This is like Trump's art of the deal thing. First, he'll try to punish. He'll hit you hard. He'll play hardball. If you don't play ball with him, okay, he steps away. Now he comes in, he does something to hurt you that he says, I will fix this if you play ball. This is classic Trump. I'm gonna try to hurt you. Nah, that doesn't work. All right. Or rather, I'm gonna hurt you, but then I'm willing to take it back. I'm willing to rescind that. I'm willing to pull it off the table. So that's really where we are with these tariff conversations, is there's already been rumblings, and my goodness, it's only been 48 hours, less than, where deals are already supposedly being made. I do not see these tariffs sticking, at least at their current levels. I think that they're going to change. I think that the energy side of things, the deal with Canada, the main problem with Canada is oil, and it's crude oil. We have tons of oil in America. It kind of doesn't come in crude though, to meet our need. Let me be very clear. It's also much easier to transport because of various pipeline arrangements, and the distillation and the midstream and post, or after stream production side of things. It's a game of locale. So we've got Gulf of Mexico, Gulf of America, whatever the heck you want to call it, drilling, and then we've got the Texas refiners that take care of both the Gulf as well as Texas rigs, and then exports and port negotiation deals, natural gas, all that. Right, that's all way down in Louisiana, Texas, and then we've got the northern sands. It's really hard to move it though, like down the Mississippi River, let's say. So it's a lot easier just to get it from Canada, refine it, and then distribute in the northern states that way. Um, that's where like the whole the secretary or whatever the position is of Ontario, Ford, I think is his last name, talking about how he's going to cut the electricity off to the Americas, and that's because the energy is basically produced in Canada and it's just shot across the border. good deal, right? That's part of that bilateral trade. Uh, at the end of the day, energy is what Canada is good for. Mexico is, yes, I mean, manufacturing certainly, but it's also a lot of agriculture that matters. So these aren't things that it would be prudent to keep tariffs on for long because it'll just upset too many people. So I think we're at the carrot phase. So again, presuming none of the other stuff about the dollar, that's the other option. Either way, it's actually a pretty positive outcome as of right now. I don't see anything that's actually showing that this is going to be a long term negative. Okay. That's a lot conceptually. Let's look at a few charts, and I think that that'll kind of put our cherry on top as far as what we're looking at and what we should expect. Weight of the evidence. That's what this is all about. So let's build or let's look at what the weight of the evidence suggests. All right. So let me double check and make sure I have got everything set up here. All right. So S&P 500. We're going to use that as our baseline index. Everybody else does. Why don't we? All right. So it is a relevant tool to use because, again, Adam, even if it's completely distorted in terms of its weightings, this is something I've talked about a lot. We do not have normalization in terms of the way the S&P behaves right now because we're still at about I think it's the number came in about 31% of S&P performance is still in the hands of about 7 companies, the Mag 7. So we want to be careful to say like this is how the stock market's doing. No, but this is how the number one index for the stock market is doing, and a ton of investors, institutional as well as retail or what we would call Main Street, you and I, in our 401ks and our IRAs and our brokerage accounts, right, is almost inevitably somebody has exposure to the S&P 500 in one way or another. When we look at the S&P 500, forgive a couple lines on this chart here, but I think it's relevant. We can see that we're only down roughly 5 to 7% from the all-time highs. Okay, so that's let's see if oh, I'm pulling up the dictionary. Let me see if I can get my fancy tool here. We can see that this little decline here, right? It's 2 weeks worth of decline. Not awesome. Nobody enjoys that, right? That's not fun. It's also very normal, right? 10% corrections happen regularly. They just haven't happened in recent history. That's one of the most dangerous parts about any correction right now is people have gotten so daggone used to. Remember we talked about short term, right? Immediate reward, immediate gratification, and making decisions on short term. We're not taking long term investments, right? Everybody wants to try to basically trade their way through this nonsense. So if things start to go down and they go down too much, too fast, right? The pile on effect can be very dangerous because psychologically, most investors are lulled into believing, oh no, this thing just goes up a ton and all I have to do is just magically just wait a day or two. And then magic wizardry happens and market goes way up and I make money. That's not that's not how this stuff works. I'm sorry that that's been what, people have been led to believe, but it is what it is, so we have to be careful. But where things are very interesting is notice this yellow box here. This yellow box goes back to a very special day in recent history. We gapped up, what we call gapping up, meaning you're looking at candlestick charts. If I were to just show you a line chart, oh, look, the stock just went up through this and then down and da 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 da. I look at candlesticks because in this case, each one of these sticks shows me one trading day. And then what this information shows me is it shows me the trading range, and then it shows me the open and close, or open and close, depending on whether it was an up day or a down day, and whether today was higher or lower than yesterday. Okay, so that's why there's different colors. That's why some things are hollow and empty, some of them are solid, right? But the important takeaway here is notice this big gap. Now, what day did that happen? That happened on November 29th. November of 24, specifically Tuesday the 5th to Wednesday the 6th. Guess what information came out on the night of Tuesday the 5th? The election results. This is very normal, right? It typically a big event like a election is going to result in a market gapping one way or the other because people go into the day with a bit of consternation and uncertainty. By the end of the night, you pretty much have a good idea as to what's going to happen. The next day, either people are elated or people are terrified. Okay. In this case, people were elated. Now, that matters because the market never decided whether it thinks that the stock market, rather that the S&P 500 index is worth this price range. So somewhere around 5,783 up to 5,868. Now they thought about it back here, right? That's what this is, oh, I think it's worth this much. I don't think it's worth this much. I think it's worth this much. I don't think it's worth this much, right? Oh, nope, it's definitely not worth this much. And then something changed and oh, it is going to be, or it is worth or is going to be worth this much. You get the gap up. But that leaves this open area of, hmm, nobody really fought. There was no tug of war to determine whether that price. So a lot of times we will find that it will recede back and try to what they call filling the gap. Okay. And that's what happened on 113 of 25. It was an up day, but we had the day before, we had started kind of, obviously, this was a big day here, right? Wednesday, the 18th of December, big down day. And then we kind of went up, but we didn't get a new high. Oh, we're going to go down again, right? This is the market arguing back and forth, buyers and sellers saying, we think it's worth this much. We don't think it's worth this much, right? That's what's happening. And then it came down, it went all the way down right to where it needed to from when trading had previously ended the day of the election. And it said, okay, now we've decided, we've come here, we've visited, we've gone over this together. Buyers and sellers have agreed. We think it's actually worth more. Whoop, shoots right back up. Great. Gap filled until we get to the 19th of February. Okay. This is basically where, we've got all this cuts in the government. We've got a lot, I mean, this is only 2 weeks ago, but a lot has happened in 2 weeks. You've got Ukraine. We've got Israel still happening, which don't get me going on that one because it's just grotesque, everything about it. But there's Elon Musk and Doge. There's all these things. So we ramped up. And then, if I'm not mistaken, actually, February 19th was the day of the DeepSeek release, which, remember, the S&P 500 is highly predicated on just a few big stocks that I had mentioned earlier in the video. There's 3 levels of concentration right now in the global stock market. We have a massive geographical concentration. Tons of money have come into the US stock market. It's not in the German stock market. It's not in the, Japanese stock market, right? Net, it has flowed into the United States and concentrated in our global market cap is way disproportionately large for what it should be, historically speaking. Okay. Geographical concentration. Next up is capitalization concentration. Not only has it flowed into the United States, it's flowed into the United States' largest of large companies. It has not flowed into our small companies, our mid-cap companies. It's flowed into the largest of large companies. All right. Point 2. Point 3, it has flowed into one sector, and that is tech. So US large cap tech sector stocks are where so much capital has flooded in. Most of that is on the assumption that AI is going to radically change the future of everything. Okay. Will it or won't it? I don't know. I could beg to say it's probably going to change a lot. Okay. But one of the predetermining factors around why these companies were valuing so high is look at these companies and look at what they have that no one else has access to, no one else can do. Nvidia's like your prime example, right? They're making these incredible chips that have this incredible capacity, and they cost so much because they're the only ones that are doing it to this degree. Therefore, that company's worth so much because they're insulated. They have what they call a moat, right? They have a protection around their business. Okay. And then China, kind of the government, a hedge fund kind of, releases an open source document and this new AI tool. Now, all the saber rattlers in America are going to, and I could do a whole other video on AI. I think it's, you want to talk about it, give me a call. I'd love to. I'll break down the history of what all's been going on and how interesting it is to the level that I understand. But I'll tell you effectively what made this so damning for American firms is not, oh, it's the Chinese Communist Party and they're going to take all of our data and blah, 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 blah. That's a bit played out at this point. Okay. The real crux of the whole thing was this firm, however they decided to do it, whoever was behind it, however much funding went into the research, because that's one of the points of dismissal is like, oh, well, this has actually been going on for months. They invested way more than they said they did. But the truth is what they used was old NVIDIA chips that are allowed to be purchased by Chinese. So that's one of the things that a lot of people don't know is like Chinese can't buy top of the line US GPUs. Like the top of the line NVIDIA GPUs, that's part of a trade war with China that's been in place. That's the Chips Act. That's a Biden, well, built on previous trade things, trade happenings from Trump's first administration, and then the Chips Act came through protecting American silicon, silicon chip producers and designers, and a whole lot that I don't even know about, but that's what the Chips Act was all about. Okay, so they used old, antiquated, respective to the current technology, chips, but they also designed an AI that had remarkable success respective to what the input needed was. And then the biggest piece of it was they published an open source document that showed everything they did. So it was not, again, this goes back to transparency. It's all about transparency, right? That's the paradigm shift we're seeing. Even the Communist parties, one of their, yeah, I guess, proxy actors or whatever you might want to call them, full transparency. And what that did was it completely unhinged the American model, because the American model is you have to spend billions upon billions of dollars to have like this cutting edge AI. And because of that, you're insulated, right? Not everybody's got billions and billions of dollars for one. So these large cap companies, right? So then you get this big sell off. Okay. Now, is that a sell off across the market? No, there's areas of our market that are doing exceedingly well. There's a sell off in the ones that are dictating how people perceive our market. It's an important point. But also the fact that it sold off to where it sold off to. It should not come as any surprise that it basically sold just below, but within the day's trading range from that day here. This was the day where we tested and filled the gap, but the actual trading day came down further, came down below that. Well, that's where we closed, even though we traded down further again, we closed right at that level. That's a short term base that we've created there. Okay. And it shouldn't be a surprise that today markets have bounced up. We'll probably see a couple days bounce, but I am not going to be the least bit surprised if we end up actually cutting down below these lows near term. We might see some support right in here, somewhere around 5,600 to 5,700. Below that, though, things are going to get a little bit unsure. So I'd like to think that we're going to be able to hold in here. This matters because this was a point of kind of consternation for the market back in July of 24. Okay, before a pretty substantial sell-off that created this longer trend line. Okay, and then we've kind of worked our way up since then. That longer trend line actually dates not back to the 22 lows, but in this case, it dates back to October of 23, because that's where we see this real kind of aggressive ascension. And that's kind of end of COVID, and that's also, basically when the AI in its current discussion phase really kind of went full live. It had actually come out before then, but that's when it was, oh, wait, this actually could be a game changer, right? And it shot everything up. Real quick, that's actually our green light indicator from our macro champ carriage house planning indicator. This is when our green light triggered. which said, let's we can be fully invested, um, and we're not anywhere close to triggering that red again yet. But it shouldn't be a surprise, right, that we came down to this level and that's where we're rebounding. Where things get even more interesting is I'm going to put what's called a Fibonacci extension, which is to say, this initial trend, right, from October 23 up, and then this retracement or this sell down here, that gives us some building blocks to look at what the next leg might look like. And in this case, it's quite impressive. I love this, but we came right up to 100% extension of this particular move. So we're getting what we call market symmetry. Market symmetry is healthy. We want that, right? When markets get asymmetrical, that means that behavior has changed. Consumer behavior, investor behavior has changed. And because of that, it becomes more difficult to predict. So, because we came up to this 100% extension line and drew back, that's actually a confirmation that this level should have some resiliency to it. And I mentioned earlier, it might come all the way down to here. Okay, 50, what did I say, 5,600. Okay, that's because that is the golden ratio, 61.8. Okay, it shouldn't be a surprise that this extension petered out at 61.8. That is one of the that is a very important number when it comes to Fibonacci ratios. And yes, I'm talking about the same Fibonacci, the Nautilus shell, the golden ratio. The human eye sees it as one of the most beautiful things in nature. It's a magical thing. It really is. It's if there's magic in this world, Fibonacci ratios are one of its greatest reflections of real magic. Um, so we can see that again, we've got some support here at 56. In this case, it's 56.75, but roughly in this range. I don't want to see it breaking down much lower than that. Now, where things get fun is let's take it a step further. Okay, that's a very short term trend extension. Let's take that trend extension further. Let's go all the way back to the 2020 lows, right? COVID sell off, shut down the economy, 14 days to spread to flatten the curve. 14 days my rear end. Okay. That was a bogus nonsense. Let's print money. Let's create inflation. Right. And then we also know what happened in 22. Fed starts hiking rates at an aggressive rate to try to tame the inflation monster of their own making. Okay. But now notice this ascension and this retracement of that ascension, right? Coming back down. Huh. Look at that. 100% extension again, right? That's a double confirmation. We're talking about building the weight of the evidence. This should have been when the market turned around. Now you might be saying, well, if you knew this, why didn't you sell everything? Okay, that's not that's not how investing works. And I say that because one, you don't know when you're at the bottom. You never know. Selling can always continue, just like buying can always continue, right? If I sold there and markets went asymmetrical, you'd be going, well, why aren't we making money? Now, I'm not obviously saying that you're going to say that to me, but that would be the rational answer. But if I sell out here and it does just come back here, and now if we get just a crazy good news, something wild happens. There's some good news overseas. I'll tell you about it in a minute. But let's get some crazy good news. Well, now it's when do we get back in? I don't know. Maybe there's more selling. So then you go through this whole wishy-washy battle. And in reality, those first couple days of that rebound, assuming it's a shallow dip, those first few days are the most impactful. Look at today. Today's a great example. What is the market up today? A percent, right? That's great. Can we get a few more follow through days? Sure, we sure can. Okay. We don't want to sell unnecessarily. If it's a taxable account, we're creating tax consequences, right? We don't want to jump the gun until we have confirming evidence of a bigger trend developing. Otherwise, this is just called investing. It comes with ups and downs. It doesn't go up forever. You need downs to create bases, to create landings. You want to climb to Mount Everest. You want to get to the peak, but you don't like climbing mountains. You want a staircase. Do you want one straight staircase that goes all the way up? God forbid you get 3/4 of the way there, you get trip on your shoelace. That's going to be a hell of a trip down, right? Instead, you build a little run of stairs up and then you put a landing in. And then you build a run of stairs up and you put a landing in. And then a run of stairs up, you put a landing in. That way, if you fall down, you land on the landing and then you can start again. Okay. That's the way we invest. Similar idea, right? We want to have landings put in place. We're getting a beautiful landing put in place here. Point for optimism, point for bullishness right now. Okay. Now, let's steer away for a moment from S&P, or you know what, real quick, just to kind of echo what I'm talking about. This is the S&P 500 ETF, one of the most popularly traded ones. SPY is the symbol. It's issued by Spider Funds, which is State Street. Large. Whether you want to argue about State Street being big bad boys and making bad things for the world or good things for the world, whatever. Point is tons of volume on this position for people who want to buy the S&P 500 wrapped up into a singular investment and not buy all 500 companies. Okay. I have two things going on this chart. Let me hide one of them for a minute. Okay. This is a volume profile for these different price ranges. And we can see here that from, again, we're just going to use those August 24 lows. So that's that kind of shorter term uptrend, that we can look at back on. And from that point forward, we can see pretty lean volume down here, meaning it hit that bottom and it just shot right up. There wasn't a lot of back and forth. There wasn't a lot of fighting about it. It was like, nope, we're going. And then all of a sudden, once we got to this high from July of 24, that's where the volume starts to pick back up, because not only have we already traded here, but that's where buyers come in and sellers come in and say, all right, now we need to discuss this, right? Back here, we agreed. Okay, we don't think it's going to be good. Oh, wait, we were wrong. It's going to be good. Okay, that's the conversation that's not being had, but we can pretend it is. And it gets here and it says, okay, now we need to start actually, let's really talk about it again. Buyers and sellers, let's go to the table and let's discuss. So you get a lot of volume. And that's where we get a little bit of choppiness. We get a little bit of resent, right? We get things that come back down. And then we get the gap up, right? This is the election gap up. Mind you, it also gapped down into this territory. This is, we don't know what's going to happen with the election, right? This was probably, Thursday and Friday. That was October 31st. And then it was like the next month's coming, right? So big institutional money's moving out at the end of the month. Options are expiring at the end of the month. There's a lot of reasons why you get those gap downs, but the idea here is there is like no volume in here because it gapped down and then it gapped right back up. So no one actually discussed this price. They had already discussed it a little bit, but then there was no discussion. We just whoop right back through it. So the question becomes, when is the market going to discuss whether or not that price is actually the right price? So it goes up and it comes down, it comes back down, and it trades all the way down right in. Again, mind you, right here, here you are. That is not a straight line, but just pretend it is. Okay, discuss it, and then no, that's not enough. We can go higher. Okay, buyers come in, they say we're stronger than you, dear sellers, and then we get DeepSeek, and then we get tariffs, and then we get GDP, and then we get everything we've already talked about. Come back down. Still really lean volume in here. That to me says the market doesn't believe that it should price in here. It is comfortable telling us right now this is not a valid price. It's at least, in this case, 580. Let's call it. We're round. 580 on the SPY, which translates to about 5,800 roughly on the S&P index. We know at least the market thinks it belongs up here in price. Now, could it come back down here? Maybe. But the reason that matters is, look, if I extend this particular point out, let's go all the way to those 2022 lows, right? We got tons of volume down in here because of all the consternation. Are these Fed rate hikes going to kill the market? Are we going to give back everything? Is COVID going to happen again? And blah, 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 blah. And then we kind of start moving into 23 and 24. And in truth, it wasn't as exciting. We have Silicon Valley Bank failure. We have the failure of the entire banking system. There's all these other speculations and stigmas that the market was trying to fight its way through. And then it kind of takes off. So relative, right? Lots of volume discussion down in here, not a ton up in here. Okay. You do have some open area for conversation down here. But in reality, I said earlier, what was it, 5,600? Okay. 5,600 puts us right in this territory. Okay. So, you know, this isn't the best profile to use when we're looking at bigger, longer trends. This is much, it helps us much better when we're looking short term, but it also kind of helps tell the same picture of this hasn't been a huge volume rally up here. So if earlier point for optimism, this might be, let's put a little weight on the scale on the negative side or pessimism, that we haven't discussed these prices as much as maybe we want to. We have discussed up here quite a bit though. So we will see, right? Now, if I took the same idea and let me spread out a little bit, let me talk about RSP. RSP, SPY is trading the S&P 500. RSP is trading the S&P 500 if you weight everything equally. You don't let Tesla and Nvidia and Apple and Google and Facebook, Meta, you don't let them have a weighting proportionate to their size as a company based on market capitalization. Instead, everybody gets the same weight. Okay. Now all of a sudden, things look maybe a little different. Okay. Let's look at that long term volume profile. Where again, it's not the most reliable, but let's look at it. Huh. Lot more discussion down in here, right? The same time frame, right? This is October 24. This is where we saw some potential kind of base action. Okay. Lots of discussion in here. Not so much right in here, right? 172. So this price doesn't translate to the S&P 500. Don't worry about that though. The idea is kind of we know where, and here, you know what, for the sake of an argument, I'm going to put SPY back on the screen here in the dark red line. Okay. But you know what? I need to actually price that in percentage so that you can actually see the scale of things. Okay. So this is that ascent up, the retracement down, another, leg up, right? We know though that we kind of feel like we have a pretty firm base in here. Well, relative to that, this is this area, right? We do need some discussion here, but below it, we have a lot of support. That is big, huge point for team optimism, team bullishness. Because what that's saying is the broader market's actually pretty healthy. What we're actually probably getting is a big rotation. Cannot emphasize this enough. I talked about it in July of 2024. We saw the start. This was a blog post. You can go on my blog. You can read about it. I sent a letter out to everybody. This is where we start to see the unwinding of this incredible three-part concentration: geographically concentrated, size, market cap concentrated, and forgive that middle finger, didn't mean that, and technology sector concentration. Okay, that's what's you know starting to unwind. So we get what we call a breadth expansion. Okay, that doesn't mean that everything just goes up, right? But it means that money is starting to spread out. Now, the one area that I've not been right on to this point, I do still believe that the discipline or the projection holds true, but it hasn't materialized yet because, as I said in the newsletter and as I've said previous times before, we have to see regulatory cuts before small caps are going to take off. We've not actually seen cuts in regulation, barring the one exciting one, which I've been emailing you and pestering you about, and I'm so sorry. But that is the BOI regulation. The Treasury came through and they said, nope, we are not going to overdo it and put this burden on you. We're going to figure out a better way to deal with this need to monitor financial affairs of business owners, but this isn't the way. We're not penalizing anybody. We're not going to enforce this CTA BOI reporting nonsense. Okay, great. That's great for small businesses, but it's going to take more than that. But if we look at the Russell 2000, which is our small cap 2000, it's our 2000 small companies. These aren't micro caps. Some of these are actually pretty big companies, but we can see that we've come way back to, oh, notice these purple lines. What are those? You might ask yourself. Don't worry, I'll tell you. First, let me get this back onto a pricing chart. Okay. And then What I'm going to do is I'm going to zoom out. And yes, you might be already reading for yourself what's this, or it may be too small. Maybe you can't read it, which is that's okay. The purple lines are key trading ranges that the Russell 2000 happens to kind of adhere to. And this goes back to 2009. And what's really interesting is we can actually see measurable cycles of when not only so it's this is a two-part cycle analysis. It's not only cycling through these ranges where it gets into a range and it kind of stays there, but we also have a time cycle that's playing out. And again, going back to 2009, which again, let's say was the turnaround point from the great financial crisis, the GFC, the market recession, and everything else, economic recession, excuse me. Um, from that point, we can find a historically repeating time frame where the Russell 2000 will stay within these particular ranges, which 535 to 910, 910 to 1285, 1285 to 1660, right? Pretty nice round numbers. Does it adhere perfectly? No, no, but we know those are pretty clear ranges. Okay. Um, at these time points, it tends to break into or out of a range. We saw it happen in August, June to August of '09. We saw it happen here in December 12 to 13, right? We broke into the next range. We traded up to it, didn't break out because it wasn't time yet, right? I mean, this is, it seems spooky that it adheres to this stuff. And you go, well, what's the science behind that? It's behavior. This is, you're witnessing behavior in real time. It comes down, but it doesn't break out the bottom of the channel. And then we get to the breakout point. Now, this one was a little bit delayed, admittedly, right? It's not perfect, but it just so happened right after the time frame extended, break into the next. We come through, we broke up into the following, but no, 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 no. It's not time yet, right? Stay in your range, stay in your lane. All right. Try again. No, it's not time yet. Oh, big ugly correction, right? That's March of 2020. Now, can I live and die by this? No, because it's not perfect, but it's confirmation of what's going on. That's the key takeaway. We are building evidence here. Okay, we went through that particular time frame, and notice these time frames are actually widening. They become less reliable as time goes on. So those time frames are going to widen. We're going to get to the point where they're not going to be reliable at all anymore. But for now, they are. Here we are. We raced up through because previously we had tried this range. We didn't really like it. Then we get artificial market forces, inflationary pressure coming from small business loan forgiveness, personal checks sent in the mail. None of this is real. So it shot the the Russell 2000, excuse me, all the way up into the next range. It tried to play around in there and then reality struck. But where did it come down? It didn't come down into the previous range. It stayed in the range that it was actually supposed to be in the first place. Okay. And then we got to the time zone of where we are most recently. And like clockwork, bless it for doing what it did. Came down, it tested. I got a little nervous. I said, oh crud, this isn't worthwhile anymore. And lo and behold, it proved itself worthy because right on the day that it was supposed to break out, it broke out, said, I'm not so sure. Said, no, 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 I am sure. No, I'm not so sure. And then we're off to the races. All the way up to, but nope, small caps aren't ready yet. It's not time yet. Okay. Come all the way back down. But mind you, we've got a little ways to go. This is all the way in February of 27 that we're supposed to see this big breakout. But the reality is we're talking about these small cap companies should start performing. Okay. We should see because we're at the bottom of our range. We just took small cap positions that are a bit more aggressive, let's say, last quarter or last month, actually, at our quarterly trades. So we're holding some small cap investments in various models. Okay. We're receding back. We're still in our zone, assuming we hold it. This is a good sign. Again, confirmation. This is a natural pullback to where we should pull back to, and we should see some development going forward. That is what we call the breadth expansion. We should be seeing it in the Russell 2000. If we don't see it, okay, maybe we're not getting the breadth expansion. But because we're not seeing it right now, let's see rather, are we seeing it somewhere else? Matter of fact, we are seeing it in two other places. One, this is an ugly one. This is a busy chart. Basically, what we're looking at here, though, is we're looking at growth and value. This is a way that we like to look at growth and value because it says, should we own growth stocks primarily? Should we own value stocks primarily? Now, we can see the horizontal red lines are years. Generally speaking, there's actually pretty important pivot points at the start of each year. Now, you can't rely on it, but it should also be one of those things where you say, hey, if we get a big shift at the start of a year, chances are that year is going to favor whichever way it shifted to. And dating back and through here, right, we can see, and I just highlighted these to look at kind of the trend and and the change. If we're going up and to the right, we're talking growth is in favor. If we're going down and to the right, we're talking value is in favor. So it's not saying like good market, bad market. It's simply saying, is growth the better place to be, or is value the better place to be? Okay. Very much a growth year in 2015, even though 2015 was pretty shaky, especially in the summer. 2016 was very shaky because 2015 had gotten shaky in the summer with the Chinese yuan devaluation and some other things that happened. Um, so value became very favorable, right? People were like, I want to be invested in the stock market. I just don't want to be in the big growth stuff. Like, give me some dividend payers, give me some value stuff, give me some stuff that's just kind of bland, plain vanilla. I'm okay with it. Okay. And then growth went really in favor, respective. And I say that because there wasn't a huge trading range, right? It's a very tight, narrow up channel. And that's because 2017 had some of the lowest volatility ever. We had very few days where we had like 1% swings. It was just a very smooth upride. Um, Things kind of flatten out a little 18, 19, right? You can see for yourself kind of what I'm talking about here. Artificial events, okay? Up and down. 2022 obviously was the ugly year for the market. It was preferable to be in value, but in truth, 2021 was very favorable to value. But in reality, nobody really wanted to be there because they were feeling too good on this high. But you're glad you were there come 2022. Okay. We were. Now we've seen this very solid uptrend with, of course, some down moves. Okay. But generally speaking, an uptrend. So we started the year 22 really hard down. And then we got the pivot point, in this case, actually in May, that growth became more favorable. That could have been an early signal for us that, hey, you know what? Maybe things are turning around, but we weren't ready to call any shots yet. From start to finish, it was a better value year, but it started the uptrend. But then we saw right there at the start of the year a big shot up in 23. Growth was a better place to be. Okay. Really got better because of the Silicon Valley Bank failure. Value really fell off the map. Okay. Went up though, petered off a little bit. Another hard move up in 24. We were in growth, right? Yeah, that's okay. It's a good thing. Nice aggressive moves up. This red hard line matters here because this was a key point before irrationality took over and artificialness took over. This was the last high of growth before COVID. So that kind of becomes kind of a line in the sand, and we can see it's pretty well adhered to. We've peaked over it, came back down, peaked over it, came back down, peaked over it, came back down. All right. So this is kind of like a normalization line. That's sort of a good thing for us. But what this is also telling us is money is flowing out of growth right now at the start of the year and into value. Okay. That's a good thing. That means money's coming out of that highly concentrated area and it's spreading out to other companies, utilities, right? They had been high flyers last year. Most people don't think of them as growth stocks, but they've been growth stocks because of electricity needs for artificial intelligence. That might be changing, right? But there's also value stocks, banks, financials, right? Financials have been doing wonderfully. Rate cuts, good for financial companies, plain and simple. Rate hikes, good for financial companies long term, not so good short term. All right. But there's other value based companies that have been really leading. But this is kind of our, hey, we're scared, right? But it's not scared. This is just coming back to the normalization line, and value is getting some interest right now. That's a great thing. Let's pivot a little bit further on the value conversation. You all have heard me talk about this plenty, but the reality is Europe is primarily a value based economy. US is innovative. We have Silicon Valley, right? We have all these great idea makers. Europe is more, not to say stodgy, old-fashioned and boring, but yeah, they are, right? You have London, which is a financial center. You have European banks, broadly speaking, are powerhouses. They don't have a ton of innovation. They have some pharmaceuticals. They have, some engineering firms. They have some, I mean, certainly industry, right? Industrial Germany historically. Um, but IFA, so we're looking at the iShares MSCI IFA ETF. Right? Look at where we are. We are at all-time highs from September of 24. But who would have guessed that Europe would be running so hard just this year? This is just this year. That's a shoot. What are we looking at right now? Let's go 12.5% positive for the year. That's great. Okay. But the reality is that this particular line has been a really tough spot to get over. It got over it once before and it came back down. Today, and let me get that off the screen, right? We can see it here. If I zoom all the way out, you're going to see here's 2021. Came up, couldn't get over it. Came up, couldn't get over it. Came up, couldn't get over it, right? You go all the way back to 2007. This was the all time high, right? So that's going to be the next point of resistance. But right now, Europe looks good. That is money flowing out of the United States, concentration point, right? Geographical concentration, and it's flowing into other economies. The other great thing, as my kids get home, the other great thing is markets love certainty. They don't like uncertainty. So even though Europe is making some pretty bad decisions, they're dealing with a lot of political upheaval. Germany, actually, one of the reasons I had to re-record this whole video set was Germany had a huge stimulus announcement last night. They basically said we're going to do anything we can to support our economy. In other words, it's QE forever. That's quantitative easing forever. That was the Ben Bernanke model of 2009, where it's we'll fund anything. Doesn't matter. We'll print money into exertion, or we'll keep rates as low as we can. We'll fund basically the German government did kind of a proxy version of that because they've got the backing of the euro. Um, Foolishly, these people, it blows my mind, but they still insist on keeping their nuclear plants offline. They've shut down their entire nuclear energy in favor of importing coal and gas from Russia. The same guys that are the big bad guys that they are still funding their own. We don't like you. Your military's bad, but we're going to buy stuff from you so you can go fund your military. Even though we could have produced it here ourselves, but we have some ideological thing that we're trying to achieve. Very stupid. But it's certain. We know the stupid decisions are continuing and they're doing this QE thing. So investors love certainty. It's just a fact. That's not an opinion, right? So America looks really uncertain. So money's flowing out of America to Europe. It will probably flow back to America. But we've been heavy exposure internationally, especially respective to other investors. And that really is, I'd rather be early and be there than not be there and be punished for it. And that's kind of one of those I want to highlight that we've had great international, specifically European exposure, but also of course Japan. We've had India, depending on the model, depending on the investment model. But that's been a real helper for us as we see the kind of fear selling right now in America, because we do have a much higher weighting internationally, and we will adjust if we need to. If it looks more profitable, or if things in the U.S. get a little bit too shaky and we break down through those support levels that we've talked about already, yeah, we'll go elsewhere. But the last thing I want to bring up, and I'm going to end it on this note, is I'm going to bring the dollar up because I do think this matters. This goes back to our conversation around dollar, gold, whatever it might be, currency war, right? What is Trump trying to do? Well, he's telling you, right? So September of 24, Trump is on the campaign trail. I want a strong dollar. I'm going to get rid of IRS, tariffs, right? But we're going to get a strong dollar, strong economy. Runs up. January 25th there, or excuse me, January 10th, right? Inaugurations like somewhere right around in here. Okay. This is where we start looking at all the real policies. Dollar starts crashing, but it really, while it was being negotiated in terms of crashing, look at the past 3 days, down, 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 and down hard. Okay. This is what's devaluing the dollar, and it's helping to alleviate the national debt. This also keeps a lid on, let's say, inflation. And what that may afford is the Federal Reserve to not only not hike rates, maybe cut rates, which would be very stimulatory, but it could also be inflationary. So it's going to be a fine balance. We're going to follow that balance. I said this was going to be the last chart. This gray area, just to note, is a significant area that the dollar will probably normalize in eventually. But I do see us actually coming to a new low before the end of the year on the dollar. I currently see it actually trading down below 100 on the way that the dollar's priced. It's priced against five. Gosh, I hope I'm right on that. Five major currencies. So it has like the Swedish krona and the Canadian dollar and the Mexican peso, Japanese yen, euro, and the pound. I think, did I get all five? I'm going off of memory there. Point being though is that's how you get to the price of like 100. Like, what do you mean 100? What? It's relative what they call currency pairs, and they aggregate and average. So that's how you get that. But you come down here, you know, I think we very well could break down below 100 if things stay on track as they currently are, and the tariffs aren't alleviated, and trade isn't agreed upon. If this is in fact more dollar and gold related and not carrot for tariff type of negotiation tactic. um we'll see. um I said that would be the last chart. I will bring one final one up because I do think it's just worth a quick note, because it does matter around inflation and rates. Ooh, this is messy. I'm sorry. It's got a ton going on here because this is one that I have to watch for different things. Um, but this is basically investor sentiment towards inflation, and because behavior tells us a lot, we can see whether or not there is a perception that inflation is going to be higher or lower going forward, and it's remarkably accurate, um, to the point where I can put. Let's see if I can get CPI to come up really quickly here. I can just do inflation. United States inflation rate year over year. There we go. All right. So you'll note when this starts to crash, guess what? Inflation comes down pretty soon after. When this starts to go up, in this case, actually, inflation didn't go anywhere, which is kind of interesting, but that's also in a period of time where we had a very aggressive rate hiking schedule. So it was a real kind of unsure period. This is really a capitulation point. This starts to run back up, and inflation is trailing, behind here, which is what it should. This should always lead. So the chart that I have up, not the purple line. The purple line should always lag. But this is telling us right now that there has been a high expectation for inflation, but it has waned. It has actually waned on the various announcements between the DeepSeek AI thing, current tariffs. There's a key convergence point on a previous trend up here. So I do think that the end of March is going to have a very something important will happen then. And then we also have another critical convergence point right over here in February of 26. Between here and here, I don't know that there's anything really significant to be aware of, but I think that this is going to be a very telling time, because we're going to have, maybe it's a Federal Reserve rate announcement, maybe it's it could be a number of things. The point is that the behavior is showing that that's going to be an important time to watch out for. So we're going to watch out for it. This has been a lot. I hope it's been helpful. Pick and choose what you think is valuable. If there's something in here that you like, I'm glad. If there's nothing in here you like, I'm sorry. I'm trying to give you as good of information and as thorough as you may be able to benefit from, so that you can, of course, not only look at the world in a more pragmatic and practical point of view, but also help kind of frame a lot of what's going on in a less emotional, much more data driven, empirical, validated kind of way. And it also kind of helps to uh, maybe lend some insight into how I'm managing the portfolios and why I am or am not making changes or trades or whatever it might be. So if you have any questions about your personal situation, please give me a call, shoot me a text, whatever it might be. And if I don't talk to you in the near future, if we don't have a meeting scheduled, I'll be in touch soon to schedule your next update meeting. So I hope you enjoyed. Bye bye.